All right, it is 7 o'clock. We're going to go ahead and get started. Welcome, everyone, to tonight's presentation. Great to see you all. I do see some familiar faces on tonight. Welcome back. And for those of you who are new, welcome. A little bit of background about myself. My name is John Mantilla. I'm one of the co-founders and director of finance here at Parco. My colleague, Danny Hampel, is also on this evening, as well as Quinn, who will be joining us shortly. Thank you both of you for being on as well. So, for those of you who are new, a little bit of background about Parco. Parco stands for Pensioned Americans Retirement Company. We do retirement and financial planning for anybody with a pension, in particular federal employees. We see ourselves as really time savers for our clients, where rather than having to navigate the financial system or navigating the retirement system or anything that you could have as a problem as you approach or prepare for retirement, you can come to us and we help our clients solve any problems that they have, because we only work with people that work for the government. When it comes to how we spend our day, it's speaking with people like you, walking through your situation, walking through the different problems that you have, and trying to find solutions. For some of those people, they're just starting out in their career, wanting to make sure they're taking advantage of all the benefits that they have available to them, and maybe that they're taking advantage of anything that's available out there for them to achieve the goals they want to achieve long term. For others, it's those maybe in the middle of their careers, wanting to make sure that they're on the right track, or wanting to really tighten up their goals to make sure that when they do retire down the line, that they're well prepared and well positioned. And then oftentimes, and I think many on the line tonight are this way, it's those nearing the end of their careers, or maybe already retired and wanting to make sure that they enjoy their retirement years that they've worked for, some people 2, 3, 4 decades, that they are making the most out of it, and that they're taking full advantage of it. So wherever you are in this spectrum, those are people that we work with. You may have seen us featured in several different publications where we're trying to get into more and more every single week. Places like the USA Today, Wall Street Journal, and Forbes have picked up articles from our teammates, and we're getting the word out there for the way we think and trying to be thought leaders in the space. So for those of you who are new to our webinars, and for those of you who aren't, it's a little refresher. The goal is to have this presentation be about 30 minutes long. We find that that's about the amount of time that people can pay attention to one topic, especially on a Wednesday night. If you do have questions throughout tonight's presentation, you have the option to do so within the Zoom window. There's a little Q&A button if you want to click that and answer questions. Myself afterwards, and then Danny and Quinn during the presentation are going to be happy to answer their questions there. And further, everybody on tonight's presentation is going to receive a link to a survey asking for your feedback, both good and bad. If you think we did something well, I'd love to hear that. If you think there's something we could do to improve, please let us know that too. If you have ideas for future webinars that you'd like us to present on, put those there as well. This week is the encore presentation of a presentation we did last week, and we actually made and added a section to tonight's presentation based on the feedback of one of the attendees from last week. So we really take that feedback to heart. So with those formalities out of the way, let's go ahead and get started. So tonight we're going to be talking about Roth conversions, finance's best kept secret. It's a question that we talk about and a topic that we talk about with every single client on every one of our initial consultations that we run through. And it's a really important strategy, especially for federal employees as you approach and enter retirement, because we often find it's really, really underplanned. So since we are going to be talking about investments tonight, and we're going to be talking about some tax strategies, because Roth conversion is a tax optimization strategy, we always want to make sure that consult a tax professional before you do anything, or consult your tax professional. We actually have a tax professional on staff if that's something that you're interested in. And then we're not making any claims about future market performance or projections with any of the examples we're going to be going through tonight. So here's the basic agenda that we're going to go through today. First, we're going to talk about the basics of a Roth account and why we see it so under-strategized, particularly for federal employees and federal retirees. Then we'll talk about the tax advantages of Roth conversions, so why Roth conversions themselves are such a tax advantage strategy. Then we'll talk about the mechanics of a Roth conversion, so how it actually works, what you need to do. Then we'll talk about some practical applications for Roth conversions, particularly around RMDs and some of the special aspects of Roth IRAs when it comes to RMDs. And then the section we added after the feedback last week is touching on this topic of mega Roths, which I think many of you have probably heard about or are curious about and want to learn more into. So with all that said, let's go ahead and dive in. First, let's talk about some of the basics of a Roth account, of a Roth IRA. So it's important to understand first, what is a traditional account? What are traditional assets? What does that mean? So a traditional account, you might have also heard is described as a tax deferred account. And what that means is that you put in dollars, or you fund that account, you contribute dollars into that traditional account that have not yet been taxed. And then the money within that account can be invested and grows tax deferred. And then when you take withdrawals out later in your life, that's when you'll pay taxes and it'll count as income. And you'll be able to take the distributions from that after those taxes are paid. So the concept behind a traditional account is that you basically are putting in money that hasn't paid taxes yet, and you're deferring those taxes to a period in your life when you may be in a lower tax bracket. Most people use these traditional accounts for retirement because they're in a lower tax bracket in retirement than they are while they're working. Roths work differently. Roths are funded with, or contributions are made with after-tax dollars, so dollars that have already been taxed, post-tax contributions. And then after a vesting requirement, which we'll go into in a minute, you get all the growth, gains, and interest within that account completely free of taxes forever. Some of you may have read the story about the investor a few weeks back who it was revealed has built up over $5 billion in his Roth IRA, and he's never going to have to pay taxes on that money again. Now, while all of us might not be able to do that, the benefits of that Roth account, of those Roth assets, are that I sometimes call it super money, and that you'll never have to pay taxes on that money again once it's vested. Now, because Roth accounts are somewhat special, there are some restrictions. The first is the earnings limit. So if you make less than, as a single person, $125,000 per year, there's no restrictions on how much you can contribute. And this is important. I use the word contribute into a Roth account. If you make between $125,000 and $140,000, there's a sliding scale of how much you can contribute. And then if you make more than $140,000, you're not allowed to make contributions to a Roth IRA, and we'll talk about ways around that in a minute. Now, if you're a married couple, and as a couple make less than $198,000, there's no restrictions on how much you can contribute to a Roth. If you make between $198,000 and $208,000, there's a sliding scale of how much you can contribute. And if as a couple you make more than $208,000, well, then you can't make official contributions to a Roth account. And again, like I said, we'll talk about ways that we found to get around that shortly. Now, when it comes to contributions, there are contribution limits. So within your 401k or within your TSP, those are employer-sponsored plans. And employer-sponsored plans, or ERISA-based plans, have higher contribution limits than an IRA or an individual retirement arrangement, individual retirement account. So for your employer-sponsored plan, for your TSP, you can contribute up to $19,500 per year if you're under age 50. And then if you're over age 50, you can contribute a further $6,500 per year. So together, that's $26,000 is how much you can maximally contribute to a TSP. With an IRA, those contribution limits are lower. You can contribute up to $6,000 annually if you're under age 50, and then a further $1,000, so for a total of $7,000 if you're over age 50. So those are the contribution limits within the different types of retirement accounts. Now, the best kept secret within finance, within personal finance, financial planning, is that there's no dollar limit on how much you can convert into a Roth IRA. And we're going to walk through the mechanics of that Roth IRA shortly. But it's important to understand the distinction now between a contribution and a conversion. So a contribution is money that you put in with your wages. So that's what defines a contribution. It's money that you've earned income, put into a retirement account. A conversion is money that you take from another retirement account and convert and move into, in this case, a Roth IRA. So you might be moving money from a traditional IRA into a Roth IRA, or from your TSP into a traditional IRA and into a Roth IRA. Importantly, there's no dollar limit on how much you can convert within a Roth IRA. So if you said, hey, I've got $100,000 in my Roth IRA or my traditional IRA, and I want to convert all of that into a Roth, there's no limit on how much you could do as that conversion. There's nothing that stops you from doing so. So within Roths, like I mentioned, that they're subject to special rules when it comes to an earnings limit. Well, they're also subject to special rules when it comes to vesting. And when we say vesting here, we talk about having full unfettered access to the growth, gains, and interest within that account. So you have to have had that Roth IRA open for 5 or more years, and you need to be over age 59 and a half to have full unfettered access to the growth, gains, and interest within that account. A couple things I want to point out here. First, you always have access to any contributions or conversions you made into your Roth IRA. That's money you've already paid taxes on. So they can't restrict you on accessing that. This strictly is applying to that growth, gains, and interest. Another important point, and something that we encounter with many clients, it's many times a day at this point, a lot of federal employees don't have a Roth IRA open. They think, oh, I have a Roth TSP, that's enough. Well, it's great that you might have a Roth TSP. We'll talk about why it's important to have a Roth IRA opened up as well. And if that's something that you need help with, it's very easy for us to assist you with opening those very fast, because it's important to get that Roth IRA open to start this vesting clock. So even if you're planning to retire this year or in 2 months or whenever, it's important just to get that Roth IRA opened to start that vesting clock. And so, we've talked about some of the restrictions with Roth, but why are they useful? You say, well, why, Parker, why are you guys talking about Roth so much? Well, a couple things. First, they give you an enormous amount of financial flexibility. And when we say financial flexibility, I'll go back to where I said earlier about how Roth IRAs and Roth money is super money. You'll never have to worry about paying taxes or any penalties on those distributions once you're vested, ever. So if you said, hey, I want to take out $50,000 out of my Roth IRA and take a round the world trip with my spouse, there's really nothing stopping you from doing that from a rules perspective. Now, we might talk to you about why that might or might not make sense financially or from a financial planning perspective, but from a restriction perspective, from a rules-based perspective, there's nothing that stops you from doing so. And then really importantly, and we talk with clients about this all the time, is the legacy planning benefits of a Roth IRA and Roth accounts. Because if your heirs inherit a Roth account or Roth assets, a Roth IRA in particular, they will never have to pay taxes on that money that they inherit, because they've already paid, the taxes have already been paid in that account. So while they will have to distribute it by the end of a 10-year period with the Secure Act's elimination of the stretch IRA, that's now part of the deal, they'll just put that money into a bank account. They never have to pay taxes on that money again. So it's an exceptionally powerful legacy planning tool that we use with clients, because if you inherit a traditional account, well, it's a wonderful thing to inherit money. If I have to distribute that money out over a period of 10 years, I might well have to pay a pretty penny in taxes on those funds when I do start distributing those funds out. Whereas if I inherit a Roth, I don't have to worry about that, and your heirs won't have to worry about that. So let's talk through the tax advantages of Roth conversions. And let's take a real example of a client like Sally. So Sally has $400,000 in her traditional assets, and she's wondering, hey, you guys talk a lot about Roth conversions, but I've got $400,000 in my traditional balance. Why would I do that? Well, we first like to point out, and this isn't always obvious, is that, well, you have money in your traditional account, be it your traditional TSP or traditional IRA. In Sally's case, she has $400,000. That's great, but she hasn't paid taxes on this money yet. So in a very real sense, some portion of this balance is not Sally's. There's an embedded tax liability within any traditional account. And if Sally said, hey, look, I'm just going to take all my money out in one lump sum, based on her tax rate and based on her income, we'd estimate that she'll have to pay a blended tax rate of over 30%. So while she had a balance of $400,000, if she took it out as all one lump sum, she's going to pay $125,000 in taxes and get net proceeds of just under $275,000. So she gets to keep less than 70% of her total account balance. Now, Sally might say, well, that doesn't sound very appealing. I want to minimize my tax liability in retirement. I'm in the 22% bracket. And if instead Sally said, hey, well, I want to take out a little bit every year, I want to convert a little bit every year into a Roth, and move that money, what we would say is, okay, look, you're in the 22% bracket. The 24% bracket starts at $86,525. And based on your taxable income, we label it as AGI here, but taxable income of $50,000, you have about $35,000 in room to the top of your next bracket. So that's the amount that we should be focusing on for conversions for the every year. We should be trying to convert this room to at least the top of your next bracket. So if we assume that tax brackets, stayed the same over the course of a several year period, Sally could convert her account, and by the end of it, she would have $312,000 in a Roth account, in a Roth IRA, and having paid only a 22% bracket because she maximized to the top of her bracket. So she gets to keep almost $40,000 more in saved taxes by just planning out thoughtfully. And then further, not only has she saved that money in taxes, she's converted that money into a more tax advantaged account, a Roth IRA in this case. So she'll have access to any growth, gains, and interest within that account once vested, completely penalty free. So that's the heart of the concept, is how do we get money from your traditional assets into Roth as efficiently as possible. That's at the heart of Roth conversion. So let's walk through the mechanics again. We touched on it just a second ago with Sally, but basically it's like I said, it's that process of converting those traditional assets into a Roth IRA over a period of several years. Now, an important thing to note is that you can't do Roth conversions within the thrift. The TSP, some 401k plans allow it, the TSP does not. So for federal employees that want to do this strategy, and for our clients for whom we do this strategy, we move money from a traditional TSP into a traditional IRA, and then from a traditional IRA into a Roth IRA. So it's a weird mechanical step that you have to do, but as federal employees, you should be aware of it. But the concept remains the same. So pretending again, Sally has a taxable income of $60,525. She has a marginal tax rate of 22%, and her traditional IRA balance is $400,000. Well, here's how we would plan it out. With taxable income of $60,525, she has $25,000 in room to the top of her next bracket. So her ending taxable income is $85,525. So she's maxed out the top of that 22% bracket, meaning she pays taxes of $14,606 when we blend it. And then she officially has net income of $70,919. When we look at her balance sheet, so that's her income statement, that's her taxable income statement. But when we look at her balance sheet, it flows like this. She has a beginning traditional account balance of $400,000. We take out $25,000 from that traditional account as conversions. And then that $25,000, after we pay the 22% in taxes, $19,500 net goes into that Roth account. And then we just repeat that process over and over and over again, gradually whittling down that traditional account, which we know she'll have to pay taxes on at some point in the future, because we're going to talk about RMDs in just a second. So she does this over the course of several years. So that way, again, assuming no growth for easy math, at the end of 5 years, she still has $275,000 in her traditional account, but now she's built up this nice, nearly $100,000 in Roth money that once she hits age 59 and a half, she'll never have to pay taxes or have to worry about any taxes on the growth, gains, and interest in that account. So a couple additional factors to consider. Obviously we went through a very simplified example, is opportunities for further withdrawals. If you're planning out and saying, hey, I need to take out, $10,000 per year to supplement my pension and Social Security, well, then that room in the bracket might change. Obviously, tax brackets could change too with the change of the administration earlier this year. We talked to lots of clients who say, hey, look, if we're going to do Roth conversions in 2021, we might as well max out to the top of the 24% bracket, because I'm not sure if the 22% bracket is going to be around in the future, or I'm not sure if that 24% bracket is going to become 27. So that's one of the factors that you want to consider as well. Also, consider the fact that, depending on how much you're taking out as a Roth conversion, it might change the taxable amount of your Social Security that might apply. Also, your retirement income, as a FERS employee, uh, your pension and your Social Security has a COLA after age 62. So with that COLA, that might, if brackets don't change, that might reduce the amount of room. So for our clients every year, we're always assessing, hey, you've got, based on how your income looks for this year, it looks like, last year we had $20,000 in room. Maybe this year we only have 17. So you always want to be cognizant of that. And then something else that a lot of people don't consider is Medicare Part B premium. So depending on how much money you make, will determine how much your Medicare Part B premiums are. And so a Roth conversion, something to consider if you are employing it, is the trade-off of, hey, maybe this year or the next year my Medicare Part B premiums might be a little bit higher because I'm employing this Roth conversion strategy to move my money into a tax advantage Roth asset. So it's something else to keep in mind. So let's talk a little bit more about some practical applications, especially with RMDs. Now, they recently aged the RMD age to age 72, and an RMD is a required minimum distribution. This is money that you are forced to withdraw from certain retirement accounts starting at a certain age. It's typically for accounts that haven't been taxed. So think for traditional assets like your traditional IRA or traditional TSP. It applies to your Roth TSP as well. But the point is that the government wants you to start taking some money out. And why is that? Well, you haven't paid taxes. A lot of people say to us, "Oh, well, I'd love to defer this money forever." Well, we understand that, but the government wants to start collecting taxes on this money. So, the government says you can't avoid paying taxes, and even though you want to, you can't. And an RMD forces you to start taking money out of your account at a certain age, starting at age 72. Now, importantly, you can defer your RMDs until the April 1st of the following calendar year that you turn 72. So let's say you turn 72 in May. You wouldn't have to take an RMD until April 1st of the following year, so nearly 11 months later. So it's one of those things to make sure that you're planning for. And when it comes to RMDs, how much you have to take out, it's based on the age that you are. There's a IRS table that you can look up. You just convert that into a percentage, and it tells you based on your age how much you need to distribute. Something we help our clients through. And then the amount that you need to distribute is that percentage, and then based on the amount of money you have in your various accounts, that applies to RMDs, or that are subject to RMDs. And the problem with it is that RMDs, that percentage goes up every year as you get older. So while it may not make as big a difference early on, as you get older into your 80s, it can mean that you're having to take out a large chunk of your balance, and it can push you in some cases into a higher tax bracket than you otherwise would have been. So the question is, well, how do we avoid these RMDs? And pretty much every type of retirement account is subject to an RMD. Your 401k, your TSP, both Roth and their traditional TSP, both are subject to RMDs. 403bs, 457s, traditional IRAs, subject to RMDs, SEP IRAs, simple IRAs, even profit sharing plans. All of those are subject to RMDs. However, Roth IRAs are not subject to RMDs for their original owners. So this is why they're so important, is that with a Roth IRA, not only can you defer those taxes, or you never pay taxes on the money again in your lifetime, but you're not forced to take the money out of that account either. So particularly for people that have a big legacy planning goal and want to just leave an asset around that just grows until they pass on. I actually had a client that I worked with today on that. Roth IRAs are particularly powerful. You can't do that with your Roth TSP. Now, frankly, you can roll the money out of your Roth TSP into a Roth IRA, and then it's not subject to that limitation. But if it remains in that Roth TSP, it is subject to that RMD requirement. Importantly as well, while we're on RMDs, you can't do a Roth conversion with your RMD. So let's suppose that one year your required minimum distribution was $10,000, and you say, aha, well, I'll just do that, take that $10,000 and just convert it. You cannot. You cannot Roth convert an RMD. And this is why it's so important to plan for this early on, either before you're retired or after you've retired, to make sure that you're getting all these things in place and taken care of long before you have to subject yourself to an RMD. In fact, our goal for all of our clients is that they never have to worry about RMDs on any of their accounts, because we help them through that Roth conversion process throughout their course of their retirement. And since federal employees get to retire relatively young compared to most Americans, um, it's completely reasonable to think that you can avoid most, if not all, RMDs if properly planned. So Roth conversion brings together the best of both worlds, because it reduces this traditional IRA balance that you have that you're going to have to pay taxes on, that's subject to RMDs, and can grow that Roth IRA component that is a tax-free inheritance or tax-free asset that you can have access to for the rest of your life. So Roth conversion allows for withdrawals with no tax consequences. So it gives you that financial flexibility, creates a tax-free inheritance for your heirs, and then it reduces the account balances that are subject to your RMDs. So the really essentially powerful strategy for anybody, especially federal employees and retirees. One last thing that we want to mention, because a lot of our clients have been asking about it, is this concept of mega Roth. What it is and how it works. Now, this is going to be particularly important for anybody that has a spouse who doesn't work for the federal government but has a 401k. So the concept is relatively simple. There's typically contribution limits, or there are contribution limits to how much you can put or you can contribute into your traditional employer-sponsored accounts. It's $19,500 if you're under age 50, like we went through before, and $26,000 per year if you're over age 50. And that's how much can go into your traditional or Roth contributions. However, on top of that, there's a $58,000 limit on basically using that vehicle that you can put in after tax non-Roth contributions. And so the concept of a mega Roth is that you put money in this after-tax non-Roth contributions. You put these into your employer-sponsored plan, and then those contributions you never pay taxes on again, but any earnings that you'd have in there would be subject to income taxes and capital gains taxes. So with the mega Roth, what you do, again, conceptually, is that as soon as you make those big contributions, you do a rollover into a Roth IRA. And then that Roth IRA grows with all the advantages like we've discussed tonight. Now, the reason why I mentioned it's important, especially if you have a spouse that has a 401k, is that to be able to do a mega backdoor Roth, to be able to employ this strategy, you need to have three things. You need to have a 401k for your work. That employer plan, that 401k, that employer-sponsored plan must allow for after-tax non-Roth contributions. Not all of them do. Further, that employer plan must allow for in-service distributions of after-tax non-Roth contributions. So you need to be able to move that money from that after-tax non-Roth contributions account into a Roth IRA. You need to be able to execute that rollover. And unfortunately, the TSP is not a vehicle where you can do that. So the reason why I said it might be important, especially if you have a spouse that's still working and you want to employ the strategy, if you have the funds that you have available to you to do so, check with their employer-sponsored plan, look through the documents, or have them ask HR and see if this is an option for them. I know some clients I've spoken to who have, we use Fidelity here on the wealth management side, and I know some Fidelity-sponsored or Fidelity custodied 401ks allow that. If that's you, it would be well worth investigating. Or if that's your family, it'd be well worth investigating if this is a strategy that you'd like to employ. And if you're confused or want more information to walk through anything that we've talked about tonight, this is what we do every single day. We're always trying to find the latest and best information that we can apply to all of our clients who work for, the same employer. It's one of the unique things about our firm is that we know where all of our clients work and the specific rules that apply. So we can get a lot of breadth and depth in terms of the strategies that we can make available to you and that we can recommend, because we know so much about the details that our client's employer and the benefits they make available to them. So I know this was a little bit of a longer presentation tonight, but it's a very important topic, especially given the fact that tax rates are uncertain in the future. Of course, here's a copy of tonight's works cited. And then in terms of some of the upcoming webinar topics that we're doing, with everything that happened with COVID, we had lots of clients asking about life insurance and FEGLI and what strategies are available and what makes sense in terms of legacy planning. So we'll be talking about FEGLI and life insurance over the next couple of weeks. Down the line, we'll be talking about retiring before age 60. We'll talk about early retirement. And then as a reminder, on the last Sunday of every month, we do our retirement paperwork webinar that Danny hosts. And it's basically an open season where anybody can come in and ask questions about how to do the retirement paperwork, or if you want somebody to walk through that retirement paperwork, we're happy to do so. As always, you can reach out to us at our website or through any of our channels. It's a pleasure presenting with you all tonight. I know this is a topic that's going to get more and more important as future tax rates change, and as you know, more and more people retire, more people are trying to get their retirement plans in place, and that's what we're here to help. So if you have any questions, please ask them in the question window. Myself, Dan and Quinny are going to be, or Danny and Quinn are going to be staying here afterwards, answering any of your questions. As always, it was a pleasure presenting to you all.